Today, we're going to talk about a topic that every single DuPont employee should be aware of within their DuPont SIP 401k plan. At Brandywine Oak, we have specialized in working with DuPont employees for 30 years, as our chairman, Steve McConey, used to travel the country to DuPont sites giving educational seminars to employees. While this is a more advanced planning topic, it can add a tremendous amount of tax-free wealth to your family wealth plan. At Brandywine Oak, our favorite type of income is income that is non-taxable. A starting point. In 2024, investors over the age of 50 are able to defer $30,500 into their DuPont SIP plan on a pre-tax or Roth basis. Most of our clients are high-income employees in their peak earning years, so our advice here is generally to defer the full $30,500 into their SIP plan on a pre-tax basis. The DuPont SIP plan is unique, and there's a third contribution option, which is a non-Roth after-tax contribution option. These contributions, as the name implies, are non-Roth, but are after-tax dollars similar to Roth. Let's look at a real-life example. A client of ours, Jim, makes $200,000 a year. He's 50 years old. He plans to earn his way to a CTP at age 60. Jim's wife also works at DuPont, earns $200,000 herself. So combined, they're over the income limitation to contribute to a Roth IRA directly. We all know that DuPont matches 6% on your 401k contributions and also makes a 3% profit sharing contribution from when the pension was frozen more than a dozen years ago. So to summarize, Jim defers $30,500. The company contributes 9% of his $200,000 compensation, or $18,000 in this example, for a total of $48,500. However, Jim still has room left to contribute purely on a non-Roth after-tax basis, as the IRS says the total dollars that can go into a 401k plan each year is actually $76,500 for those who are age 50 or older. So in this example, Jim could actually contribute an additional $28,000 of non-Roth after-tax contributions. Now, why would Jim do this? Because once a year, Jim could call into the Merrill Lynch DuPont Retirement Education Services team and ask them or instruct them to roll over and convert this $28,000 to his Roth IRA at Vanguard or Fidelity tax-free. This second step is absolutely critical, because if Jim simply left the $28,000 of non-Roth after-tax dollars in his SIP plan, the earnings on this money would be subject to ordinary income tax in the future. As soon as he rolls his $28,000 out of his Roth, all future growth and appreciation on these dollars is tax-free. Over 10 years, from age 50 to 60, Jim could get $280,000 into his Roth IRA via this strategy. If his wife does the same exact thing, that's $560,000 of additional Roth dollars for the family. At Brandywine Oak, we aim to ensure our DuPont clients are taking advantage of every possible loophole in the tax code to minimize taxes. We believe it should not be called net worth, it should be called net keep. So what you actually get to keep is after taxes.